Ever wondered what a compounding machine is? The concept is simple. A compounding machine is an investment that grows at such a high rate that an investor holding it becomes wealthy, extremely wealthy in fact. You must be wondering how wealthy and how fast. Again, the answer can differ based on whom you ask. But I think a simple explanation suffices. 100 times your capital in a generation, commonly defined as 25 years.
In our earlier video, we have already covered the first ingredient for creating a compounding machine, which is the return on equity. In this video, we will be covering the other two ingredients to create a compounding machine. Once the investor uses all three ingredients to analyze stocks, they are immediately able to separate the compounding machines from the ordinary businesses that surround them. In fact, when we multiply ingredients 2 and 3 together, we get the intrinsic compounding rate of wealth creation of a business. Investors can then use both these metrics to shortlist companies as well as to monitor them and benefit from owning long-term compounders.
By fully following this video, investors can judge the quality of a business, which is the first and most important task before an investor.
In fact, without knowing the quality of a business, it would be almost impossible to judge the fair value of a business. We have already covered return on equity in our first video on quality of businesses. However, for purposes of this video, we can sum it up as return of equity is nothing but the net profit divided by the owner's capital. So return on equity tells us the rate at which the business is currently returning profits to its shareholders. However, you will notice that nothing is stated in this ratio about the profitability of the company in the new projects it is undertaking or on the additional business it is going to do every year. Enter return on incremental equity.
Hi, this is Prashant Saraf and you are on my channel Blueprint Investments. I am on a mission to arm investors with the knowledge, strategies, skills and tools to create life-changing wealth for themselves and their family. Coming back to the video.
To calculate return on incremental equity, we need to calculate the additional capital the company has deployed this year versus the extra profit it has generated using this capital. To make this simple, let's take an example. A company A has used 100 crores of capital in year 1 and generated 20 crore rupees of profits on the same. So its return on equity is 20%. Now next year, it reinvests 100% of this 20 crore rupees profit in the business. So its capital has increased to 120 crores from 100 crores. Now next year, this company shows a profit of 26 crores instead of 20 crores. In other words, this company has made 6 crore additional profit on the 20 crore additional capital it has deployed. The company's return on incremental equity then is 6 crores divided by 20 crores or 30%. In the example above, this is an extremely encouraging sign as the business is generating higher returns, 30%, on the incremental capital than its historical average. Now let's take another company B. Assume that this company B, has invested 100 crores in year 1 and generated 20 crores profit or 20%, the same like company A. Now, suppose in year 2, the company only employed 10 crore rupees of additional capital and returned the rest as dividend to its investors. Now, company B has only reinvested 50% of its profit back in the business and has returned the rest to its shareholders. So, company B's capital has increased to 110 crores from 100 crores in the first year. In the next year, the company shows a profit of 21 crores. In this case, the company B has only made 1 crore extra profit on the additional capital employed of 10 crores. Now, this is not a good sign as the company's return on equity has fallen from 20% historically to 10% on the additional equity. This will be the case of a company which is growing without adding value to its shareholders. As investors, we would like to invest in companies like company A and not like company B. As you can see, return on incremental equity when used in conjunction with return on equity can be extremely powerful in highlighting whether a company's growth is adding value or not. This is because, as shareholders, we want to not only ascertain whether the company is making high returns on the current capital, but also on any of the new capital which is being employed by the business. Let's now come to the next ratio, the reinvestment rate. Well, reinvestment rate is nothing but the rate at which the profits earned in the business are reinvested back in the business. We have already covered this in our example above of two companies A and B. In the case of company A, it had reinvested the entire 20 crore rupees of profit back into the business. So company A had a reinvestment rate of 20 crores divided by 20 crores or 100%, while company B had only reinvested 10 crores out of the 20 crore profit it had made. So company B has a reinvestment rate of 10 crores divided by 20 crores or 50%. Now, which company do you think has a better reinvestment rate, company A or company B? If you answered company A, you are right, because we are really looking for companies which have lots of opportunities to deploy additional resources and capital. They can then earn high returns on that additional capital. So this combination of high return on equity, high reinvestment rates of that return, and then finally high returns on incremental equity creates a compounding machine. These type of compounding machines can generate high returns for many years and decades, and these are the companies that become 100 baggers in investors' portfolios. What is astonishing about this exercise is that two companies with obviously similar numbers can have two such different growth paths. Finding these three important metrics, return on equity, reinvestment rates, and return on incremental capital employed, should be on every investor's watch list. Investors can use these metrics to shortlist companies as well as to monitor them and benefit from owning long-term compounders. With that, we come to an end on our video on reinvestment rates and return on incremental capital.